Hi traders, it's Tom here from FX Evolution. So is the stock market drunk right now? Hysterical? Or has it just completely separated itself from reality during this COVID-19 outbreak? It'd be interesting to know what the federal chairman Jerome Powell thinks after his $5 trillion stimulus spending spree. Does he think the market's going to have a V-shaped recovery, U-shaped recovery, or is it possibly on a rocket ship to the moon? Let's take a look.
I need a dollar, 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 that's what I need. Hey, hey.
Okay, so while that's really funny, of course, let's talk about what the actual stock market's doing right now and potentially what might happen in the future and a few different scenarios of what we're seeing. So I think it's very clear that we've seen a massive hysterical run in terms of how bullish this last move is. And what we generally talk about here at FX Evolution is that things like to move in uniformity. So if we can see here, first pull up is about that long in terms of points. The second move right to pretty much the pip in terms of which S&P you're looking at, it hit around 2,900 in some of the futures contracts. So 2,900 has been hit. That is the same length distance, which is very important. And what we expect to see is some form of resistance at this level. Probably about as good a bits of news have come out. We had previous support here, which acted as previous support. And then of course, that previous support may act as role reversal in the future, become resistance. So that's an important fact whenever you're thinking about a hysterical level or a level being breached. The market always likes to kind of go to these zones. It always likes to test everybody. And of course, when all of the bears are gone, when you least expect it, that's when the bears will come back. Unprecedented monetary stimulus from the Fed has obviously helped, and I don't think we'd be here without that stimulus. And that is different to other crashes, but we are also seeing an complete shutting of economies globally when the time of globalization is now and has been for the last few decades. So there'll be several stocks that will be watched by the market. Obviously, one of them will be Amazon. How much does it shoot the lights out? It will have a good report. I think no one thinks it's going to have a bad report. The question is how good. Apple will be one to watch with all of their stores being closed. That will be a market leader, being the biggest stock in the market. Microsoft as well, how has it fared? Most people think it's fared pretty well, but what about the other sections of its business? So I think Apple and Microsoft will probably be key to the sentiment of what Wall Street thinks, and potentially they might even have great results and they didn't meet what Wall Street thinks. So that's one part of the technical analysis here. But I think the second section is that while this has happened before, if we look at the 2008 crash or we look at any of these other crashes, all of these things happen time and time again. So if we jump out to a weekly and we think about what's happened previously and we go back over here and we go back to the 2008 crash, we can see here as a percentage, this rally was actually quite significant. So this rally rallied from 1254 all the way up to 1434. And you can see the previous support became resistance. Very similar scenario to what we're seeing right now. If we also go back even to the tech bust, big bust off, came to 1000 kind of 90 area, and then again came to a role reversal zone where previous support became resistance. And this is very common with the bust and then of course the boom afterwards. These ones may not have had as much QE stimulus. The quantitative easing came in around here at the end of the GFC. So that was the first quantitative easing announcement. And then of course it did have that little bit of a sugar rush and then fell off. But people were incredibly concerned about debt. There was a huge amount of fear and they didn't have that confidence in the quantitative easing scenario or concept at that point like they do nowadays. So look, the stock market has had a miraculous recovery, but where to next for the stock market? So let's bring up a couple of different, I guess, key bits of information I think that we should all be looking at over the next month as to where could it go next. All right, so the first one's going to be the Shiller profit earnings ratio. Now, this is not necessarily a great indicator of where the market's going to go or whether the market's overvalued, but what it does show you is it shows you like a profit earnings ratio based over a period of time. You can read up more about Shiller if you want to. But we can see during that 1929 crash how high the Shiller was, and the Shiller is relatively high in terms of in line with the profit earnings ratios back then, around 30, and we're probably sitting at around a bit higher than 26.91. I'd say this is a little bit delayed. The tech bust was obviously an incredible ratio, and I think it's important to note that there's a lot of tech companies that are in the S&P 500, and they are going to be valued at a higher profit earnings ratio. So the standard shouldn't be down here anymore, potentially even where the mean or median are, but we are quite far away from that point. So there is a huge amount of overvaluation potentially in the stock market as a whole, considering what's going on with this current crisis. And that's why I wanted to bring up with this Shiller ratio. We can see the different busts, where the levels were. Obviously, this was the GFC bust, the earnings point down here. Now, with printing more money into the economy like they've done since quantitative easing, I think it's fair to say that probably profit earnings or Shiller PE will be higher, but maybe not as high as this point. So there's definite room for 20 to 30% downside in terms of Shiller PE ratio. Let's have a look at another couple of scenarios that I think, are very, very important to look at when we're talking about the US, which is the economy that everyone's going to watch, and especially when you're trading the S&P 500. So here we've got an article, and it basically says here, obviously shocking report shows half of the homeless at a Boston shelter tested positive for COVID-19 and none of them had the symptoms. And this is the problem with this virus. Look, we're not medical experts, but obviously America has got a huge disparity between the rich and the poor. And we've covered that before in terms of wage growth. If you've got more people out in the street and more people homeless during a crisis like this, and you reopen the economy too soon, unfortunately, these people are more susceptible to getting this virus and therefore being super carriers because they don't have anywhere to go. And I think that's the biggest problem that we're going to see. If we have a reopening of the economy, and I've got another article here, this time it's from MIT in terms of they're thinking that if we reopen or the reopening of the US economy is too fast, then there could be absolute dire consequences in terms of seeing the spike go back up. What do you do? What happens when you close the economy again? The US market has most likely not factored that in. So here we've got researchers at MIT trained neural network modal data. Basically, they predicted that around the 20th of April was going to be the halting or the highest point, and the point where we start to see decline in the US in terms of infection rates. But the problem is these same guys that have fairly well predicted the spread are also saying that most of the measures that they see in the government information booklets sent out to the states and everything about what's going to happen during the reopening, this is not going to be sufficient to halt the spread of the virus during what we would call the second phase. And I think that's the big problem. The second phase may not be priced in to the stock market right now. So that's another point. And then we go to the last one here, which we'll make before we get back into the charts. And that is that even Goldman Sachs don't even seem to know anything about what's going on. Now, it's not new that they say multiple different things because, look, time is changing. You've got to give them some slack. But I think the important thing is last week, if we highlight this, Goldman literally said that they were going to see potentially up to a 3,000 forecast for the end of the year. Now they're potentially even changing that again and saying, okay, well, now we expect a worse plunge in terms of Q2 earnings, and we expect worse potential spending and stuff like that. And now they're even joking about whether the federal chairman and all of the money that's being pumped in is even enough to hold it, and they could potentially see even further downside. So it really proves that no one necessarily knows. And if they're predicting, let's say, a 3,000 forecast by the end of the year, and we're sitting at 2,900 or 2,870 on the S&P, what incentive is there for traders to take the risk on? And that brings us back to our charts. Let's now have a look at the S&P 500 chart again and think about what's actually happening right now and what potentially might be happening in the future. So it's really important that we consider that they're expecting the market to get to here by the end of the year. We're currently here. Would I risk my money as an investor to potentially make 3 to 4% when the downside is 2200 or even below. It potentially could go there. So that's the problem I think you're seeing. It's not just that the market's on a sugar rush and the market's feeling great. How much more capability does the Fed have good news? Is there a chance of a vaccine in the next month? Is there a chance of the second ret infection? These things you need to consider. Even as technical analysts, if you're investing in the S&P 500 or investing in stocks longer term, you need to think about this. And I think there's really two key cases for where, or three key areas for where the market could go. We've got the first area is basically back to test the lows. That's definitely an area and definitely a scenario. I think that if the market does come down and start selling off aggressively, that is the most likely scenario. The second scenario is we test these kind of 1800 zone, support zone. So we test that level again and we see that point, and of course we're knocking around 4 years off the S&P 500 growth. Then if we're thinking the most bearish case scenario, and probably the point where you go, wow, this is serious value, and it makes percentage sense as well for this to occur, the 1600 zone. So if we think about it from a general crash in the economy, whenever you see a recession, generally the S&P 500 goes between 40 and 55% down. If we're saying the high is 30, let's say 3,400, if we're taking 50% off that, we're basically hitting 1600. And that would be a super resistance becomes support scenario. And definitely there's going to be so many long-term investors picking up that zone. But it's going to be very difficult to pick up a zone like that because the news will look so bad at that point. So massive amount of money going into the market. Three key zones that I guess we're looking at in terms of these zones make sense, and it makes sense for them to potentially test. And I think the rate of the second infection or the spread of that has not been properly priced into the market. I think the market expects it to potentially just go away or for us to have a solution. And even if there is a drug and that drug helps people that are obviously critical, it doesn't stop necessarily people getting infected with it. The vaccine is the solution or the long-term solution for that. And it's very difficult to pull a vaccine out in 6 months or 9 months correctly and potentially have to vaccinate everybody in the world. And I think that's the thing. If you're vaccinating a couple of 100,000 people, here you're vaccinating potentially billions of people with this vaccine to eliminate this spread. And that has never been done in the history of mankind. So that is going to be the big question on everyone's lips. And I think we should definitely pay attention to the news, pay attention more importantly to the technicals. And what we might be seeing is we might see something where the market creates a double top pattern, breaks through the intervening trough, and then starts selling off. And if you see this, as the market makes a series of lower lows and lower highs, these are, from a trader's perspective, the opportunity to potentially start to think about placing shorts and placing sells down to these key zones. If it breaks through this zone, 2000, 1800 definitely open. So all of this thing we'll talk about on this channel. Please like, subscribe, comment below if you have any questions. These things will play out most likely over the next coming months. And I don't think we're seeing it yet. I don't think we've seen the bottom of the market necessarily, but we have definitely seen the sugar rush and the governments are panicked. That is for sure. So we'll see you in the next video, and thank you very much for watching. Bye.